Walmart stock is up 100% since 2 years ago. This is November 2023. November, December, January, it was hovering around 50, 53, something like that. And now it's more than doubled in just 2 years. It's gone up from around 450 billion up to almost $900 billion. It's trading at a P of almost 40 times. Should you buy it? Today we're gonna go over the numbers. We're gonna analyze the stock. We're gonna take a look what's going on here. So first of all, dividend, a measly 0.8% for a company that's I don't know, 50, 60 years old or more. I'm not even sure, but it's a very, very mature company. And you're gonna see that combined with buybacks, the shareholder returns are very, very low. Why? Even though the revenue is 700 billion, which is huge, the margins are very, very low. It just doesn't have the cash. It just doesn't produce enough cash flow to give back to the shareholders for a meaningful return. So first of all, let's take a look at the graph in more detail, because here on actually it does offer all of the history, but we cannot select the parts that we want to take a look at. Because this is a very old and mature company, because this has been on the market for so many years, it's gone through many economic cycles. So first of all, as you can see here, before the dot-com bubble, before the year 2000, it has also gone up a lot. Not because it was a tech stock, but because the market was getting very overvalued and people were going crazy buying up stocks that had no revenue, and there was a lot of mania and euphoria during that time. So why did Walmart go up back then for so much? Well, basically, the reason is fear of the market crashing down. So it's basically a flight to safety in a way. It's not because Walmart is turning into Nvidia. It's just going to grow the same as it has been, 3-4% top line, 3-5%, maybe sometimes faster with inflation. But yeah, as you can see here on the graph, we have seen this movie before. Okay, we have definitely seen this movie before. But the problem is, guess what happens when you buy Walmart after it's gone up 100, 200, 400% in this case? Well, it's just gonna go say, actually, even before this rally up in the 2000s, there was another rally in the late 80s that made the stock go break even for about 7 years or more. So after that, what happened? Well, basically, this is the year 2000, 1999, 2000, stock market crashed. Walmart did not go down a lot with the market. You did not feel the stock market crash if you held Walmart stock. It was one of the very high quality and premium stocks back then. It still is quite high quality and stable. But yeah, if you would have bought at the end of 2000 out of fear because the market's going to crash, because it's overvalued, because it was in a bubble, the market was in a bubble, then what would happen is you would have underperformed. It's just basically you would have put money into something that's going to be dead for not just several years, not 6-7 years, but I mean, look at this. It went sideways until 2011, then had a small rally, came back down, got back down to around $20. So if you bought here at the top, around $19, $20, you would have had 15 years of your money going nowhere, 17 years almost. This is extreme underperformance, and yeah, even though you may have been paid a small dividend, it still would not have been worth it. You basically would have done very, very poorly if this was your top position at the time. So today, Walmart also went up by a lot. This is let's take a look at the market cap. This is number 14 in the world. Walmart, a retail gross. I think Walmart stock is does not include other countries. I'm not sure. I know that, for example, they have a different kind of company and different stock listed on the stock market for Mexico, which is Walmex. And I'm not sure if they have some other type of company for other countries, or even if they are present in other countries. I think they had some business in China. I'm not sure how that ended up. But anyway, went up massively, okay? Out of fear. But what would happen if you put any money in it right now? Well, we have already seen this movie before. you would probably not lose money in terms of the stock going down, but it's not going to go anywhere anytime soon. I mean, just underperformance and flatlining is pretty much locked in from here on out. Okay. But I think even Walmart can go down by a significant amount. I think when this is going to crash, when this starts crashing, it's not going to be your typical 15, 20%. It's probably going to go down some more. Let's just take a look here to check market cap. So as you can see, rising, flatlining in the 2020s for a few years. Then for going from 450 almost up to, so it's basically doubled in a very short period for this kind of stock that grows. How much does it grow? Well, let's take a look. Low single digit numbers, 6%, 4%, 5%, 4%, 2.5% in 2025. These are the quarters that's been putting out. Okay, you have 2023, 6, 7%, 6%, 5%, 4%. So it went up a little bit because of inflation. Up when we are talking about Walmart, when it goes up, when it starts accelerating the growth, it goes from 4 to 5% up to 6 and 7. So what are we talking about? I mean, look at this, 2016, down a little bit and then up, less than 1%, 3%, 3%, 2%. So these are the type of numbers that it had pre-inflation. And the numbers that it had after 2021, when inflation started to kick in, this does not cover the inflation. I mean, you would have made money basically if you invested 2021, 2022, just because the stock's gone up a lot recently, but not... the shareholders' returns were very, very mediocre to basically flatlining. Let's take a look at the net income. What's been going on here? So almost 10 years ago, they were doing 14 billion, had a rough period, back up to 14 billion, 15. 2023 down to 11, 12 billion, and now we're doing 23 billion. So it's growing, but as you can see, it can grow and then flatline for quite a few number of years. But usually net income is going to be a bit more volatile than other numbers. We're not going to take a look. We mostly take a look at revenue to see where if the company is stagnating, not net income, because that can fluctuate a lot. Let's take a look at the shares outstanding. So it's going down over time, but as you can see here, last 3-4 years, pretty much flatlining. So from 2022, they reduced about the share count by 200 million. And then the next year they did only half of that, 100 million. And then was that like 30 million? Not even 30 million, 29 million. And now, yeah, it's been slowing down a lot. In terms of percentages, let's take a look here. Several years ago, they were doing 3% reduction in share count, which is real good shareholder return. Combined with a nice dividend, you would get 4 to 5% even. We're going to take a look at the total returns after this, but look at this, 4%, not even 4, just 3%, 2%. And now what we're getting, because the market cap got so big, because the valuation is so high, we're not even getting 1%. So look at this, 0.5%, 0.3%. And this is burned money. Why? Because they are pouring the money into buybacks. They did not stop. So repurchase of common stock. About 10 years ago, they were doing 8 billion, 7 billion, also 10 billion, 2023, 10 billion. Trailing 12 months, they did 8 billion when the market cap is almost $1 trillion, 900. So that does not do nothing. It doesn't do anything for the market cap. It doesn't fuel the share repurchases. It's just burned money. Common dividends as well. They just paid this. It's under 1% right now. Doesn't help us at all. Let's take a look at the ratios here. Total shareholder return. They were doing 4, 6, 5%, 4%. This was a very nice company to have to buy and hold when they were doing 4 to 5%. I would have bought this back then as a ballast to my portfolio, as something that maybe I would use as a cash position, but not as an investment looking for big fat returns. But now shareholder returns are around 1%, which is not really good at all. Let's take a look at the margins real quick here. Gross margins is doing pretty much what it was doing since 2 decades ago, 25%. This is a retailer, so very low gross margins and operating margins around 4%. It's very consistent around 4%. So this is a very, very large, very small, thin margin company. And this is the business model. This is not, it's not broken or anything. It's just very capped. It cannot go much higher than this, no matter what it does. So profit margins as well, 2% FCF margin. That's the business model. So why did the stock double? Did the margins improve? Did the revenue start accelerating by a lot? No, we don't see anything crazy numbers here. We don't see 20% growth, trailing 12 or 15 or 13 or 9 even. Do we see any improvement in the other metrics, operating margins? No, there's pretty much flatlining. Exactly what you would expect from this. So that's exactly why people are piling in right now in Walmart. The flight to safety. They're scared about the market being overvalued, and they just want to be more involved as having Walmart a bit more as a part of their safety when it comes to portfolio strategy. A lot of money managers are finding safety into Walmart stock. So cash and cash equivalents, 10 billion right now they're sitting on. 10 billion, market cap 900 billion. Yeah, doesn't do anything. Cannot do any significant repurchases. Let's say stock market goes down. Not stock market, the stock itself goes down 40% or more. This $10 billion does nothing. They have to go into debt to make any significant repurchases to help mitigate the drawdown. Shareholders' equity not moving very much. Trailing 12 months, 100 billion compared to 10 years ago, it was 83 billion. So not moving very much. Net cash, they have debt. Total debt here, 68 billion and rising since 2022. Rising since 10 years ago slightly, but that's fine. It's not a significant amount, just very cautiously done according to the growth of the company as well. So they maintained probably the same type of percentages in debt to profit and stuff like that. Net cash, pretty much at the same level there. So this company is very, very consistent across the board with every single metric. The only problem here is, oh, look at this, P/E ratio, 39. Okay, this is crazy. Look at this. It was trading around 20, which was already kind of high for the low margins that it has. Actually, 10 years ago, it was at 15. So at 15 times price to earnings, you definitely would want to buy this and own this, not to try to get any type of fat returns, but just as a solid brick in your portfolio. Maybe you can use this as a cash position, definitely at a 15, but it just offers you a lot of optionality and safety. But now the multiple has expanded. It went from 15 to 20, 21, 24, 25, 37, and 39 today. So what do you think is gonna happen with this? Is it just gonna expand on the multiple forever? Is this gonna go from 40 to 50 to 60 to 70? Is this the next Nvidia? Why are people piling in? And is it gonna continue forever? So obviously, if you think of buying stock, Walmart stock, because it's gone up a lot, that's doesn't make any sense. Is it gonna continue to go up? Very, very unlikely. Is it likely that it pops in the valuation and you're gonna see some people hurting? Very likely, actually. So forward P 39. I think this is more expensive right now than Nvidia. Okay, Nvidia forward P 27. So look at that. And as you can see, Nvidia is growing underneath. It grows their earnings and their top line. Let's take a look at the income. Revenue growth, 65%, 100%. Big fat margins and improving, okay? So Nvidia is at a 4.3 market cap, 4.6 trillion, sorry. 4.6 trillion, and look at this. It can reduce the shares outstanding by more than 1%. Okay, look at this. Free cash flow, net income, 100 billion in net income, trailing 12 months. And they repurchased 51 billion. So that's more than 1% out of the market cap that they have right now. So that's great. Let's go back to Walmart. Forward PE, again, 39. It's ridiculous. Just going up and up and up. EV to EBITDA. 7 times around 10 years ago. Just going up, expanding. Same story as with Ford price earnings. So all the multiple metrics have gone up a lot. But the company underneath doesn't have any type of accelerated growth to justify the expansion in price. So return on capital invested, 10%. This is fine. This is decent, but it's not at any compounding type of level. It's just decent and acceptable. I think it's a little bit lower than the S&P average. I'm not sure what the S&P average is right now. I think 12% is right now because Nvidia is such a huge part of the index. But yeah, FCF yield It was trading at 7 and 10%, and now 1.6, 1.7. I mean, this is insane. This is so crazy. I mean, you're just gonna get hurt. If it doesn't drop in the next few years, you will definitely be just flatlining for more than a decade, like it happened before. Yeah, that was pretty much it about Walmart stock.